12.34%. That's the office loan delinquency rate in America right now, and it just shattered every record set during the 2008 financial crisis. We are no longer approaching a housing crisis. We are inside one, and it has now entered a phase that changes everything you thought you knew about buying, selling, or holding property in this country. Here's the full picture. The U.S. economy shed 92,000 jobs in February alone, the third month of job losses in the last 5. Consumer sentiment just collapsed to 55.5, the lowest opening reading of any recession in half a century. The Federal Reserve has now cut interest rates 6 times, and mortgage rates went back up anyway. They touched below 6% briefly in the first time since 2022. Then a new overseas military conflict erupted, oil spiked, treasury yields jumped, and within 2 weeks, the 30-year fixed was back above 6.2%. The one lifeline this market had, lower rates, appeared for 14 days and disappeared. Here's what we're going to cover. First, we'll walk you through the hard data showing how the American housing market has split into 2 completely separate economies. Why Hartford and Kansas City are hitting all-time highs while Austin, Tampa, and Florida condos are sliding off a cliff. Second, we'll show you why the commercial real estate debt crisis we flagged months ago is no longer a warning. It's a current event. Nearly 2,000 banks are sitting on dangerous levels of exposure, and the FDIC just pulled back the curtain at the worst possible moment. And third, we'll explain what Phase 3 actually means, why it's called the fracture, and why the choices you make in the next 6 to 12 months carry a price tag that could swing by tens of thousands of dollars in either direction. Let's get into it. Start with the macro foundation because nothing in the housing market makes sense without it. In our Phase 2 coverage, we laid out forced selling, the lock-in effect unwinding, negative equity spreading, and rate cuts failing to move the needle. All of that is still unfolding, but now something more serious has been layered on top. The labor market has broken down. Non-farm payrolls lost 92,000 jobs in February 2026. That's the third negative print in 5 months. December's numbers were revised to a loss of 17,000. Averaged across the last 12 months, the U.S. is generating roughly 13,000 net new jobs per month. That is functionally zero. Federal government employment alone has dropped by 330,000 positions. Long-term unemployment has climbed to 1.9 million people. Labor force participation fell to 62%, its lowest mark since December 2021. Why does this hit housing so hard? In Phase 2, mortgage delinquencies were painful but manageable because most distressed borrowers still had income. When income disappears, a delinquency turns into a foreclosure. Right now, 850,000 borrowers are 90 or more days delinquent or already in active foreclosure, and the highest volume since July 2022. These are people hanging on the edge, and the job market just shoved them closer. Meanwhile, the Fed held rates at 3.5 to 3.75% at its March 18th meeting, its second consecutive pause. Inflation is still running at 2.7% PCE, revised upward from December. The dot plot signals just one additional cut for the remainder of 2026, with markets not pricing that move until September at the earliest. And those mortgage rates, here's the full story. In late February, the 30-year briefly touched 5.98%, first sub 6% print since 2022. For about 2 weeks, it genuinely looked like buyers might get some relief. Then the U.S.-Israeli military conflict with Iran began on February 28th. Oil surged. Yields followed. And within a fortnight, the 30-year climbed from 5.98% back to 6.22%. 4 years of waiting for that affordability window. It lasted 2 weeks. The consumer is getting crushed from every angle. Michigan consumer sentiment is sitting in the second percentile of its entire recorded history. Personal savings dropped to 3.6%. Household debt hit a record $18.8 trillion. Bankruptcy filings are up 14% year over year. Commercial Chapter 11 filings have surged 67%. This is the environment Phase 3 is operating inside, and the Fed is frozen. The labor market is contracting, the consumer is maxed out, and a geopolitical shock just closed the one door that could have helped. Before we get into the fracture data, a quick word: sub 6% mortgage rates appeared and vanished in 14 days. If you're depending on the algorithm to surface this information, you're already behind. Hit the notification bell now, so the moment we drop new data, you're first in line, not catching up 2 days later after the opportunity has moved on. Now let's get into the first major story. The housing market has cracked into two distinct economies. On the surface, the national numbers still look passable. The median existing home price was $398,000 in February, the 32nd consecutive month of year-over-year gains. But that headline obscures a massive split happening underneath. The Case-Shiller National Index gained just 1.3% nominally across all of 2025, the weakest annual appreciation since 2011. Adjust for inflation, and real home prices have been declining for 4 straight months. New home prices are falling outright, down 6.8% year over year to $400,500. Here's where the fracture sharpens. On the declining side, Tampa's Case-Shiller Index has fallen for 13 consecutive months, now down 3.9%. Florida condo prices are off 6.1% statewide, with 92% of major condo markets in retreat. And the reason for the Florida condo collapse is critical to understand, because it's the sharpest example of Phase 3 in action. After the Surfside tragedy, Florida mandated structural inspections on aging buildings. The result? 40% of condo owners have been hit with special assessments over the last 3 years. Some are running from $134,000 to $400,000 per unit. Stack that against homeowners. Insurance averaging $7,500 to $14,000 annually, 181% above the national average. And you have sellers who aren't listing by choice. They're being forced to liquidate. That is Phase 3. Austin carries price reductions on 48.9% of active listings. Dallas is down 4.1%. Denver is off 3.6%, with luxury attached homes sitting at 26 months of supply. Phoenix remains 7% below its 2022 peak, with 63% of listings showing cuts. On the appreciating side, Hartford, Zillow's top-ranked market for 2026, has inventory running 63 to 74% below pre-pandemic levels, with only 16.5% of homes seeing price cuts. Boston was named the hottest large metro. Kansas City prices rose 5.2%. Toledo is projected for 13.1% growth. In our Phase 2 video, we flagged the risk of the Northeast and Midwest becoming overvalued while shedding population. That long-term risk remains real over the next 12 to 18 months. But migration data has shifted in a way we didn't anticipate. The entire Midwest region recorded positive net domestic migration for the first time this decade. Ohio swung from losing 32,000 domestic migrants in 2021 to gaining nearly 12,000. Michigan completed a similar reversal. People are abandoning overpriced Sunbelt markets and moving toward affordability. Florida, meanwhile, went from attracting 310,000 net domestic movers in 2022 down to just 22,000 in 2025, a 93% collapse in migration. Tampa's inflow dropped 70% in 1 year. Orlando's essentially evaporated. United Van Lines now classifies both Florida and Texas as balanced states for the first time. Miami-Dade posted the worst domestic outflow of any high flood risk county, more than 67,000 people leaving. Two Americas, two housing markets, that is the fracture. Now negative equity and foreclosures, and these numbers have deteriorated since phase two. Negative equity has grown to 1.2 million homes, up 15% year over year. 2.1% of all mortgage properties are now underwater, compared to 1.3% just 12 months ago. FHA delinquency is running at 11.52%, up 74 basis points in a single quarter. FHA now accounts for more than half of all serious delinquencies nationally, despite being a fraction of total loan volume. Foreclosures have risen for 12 consecutive months. Intercontinental Exchange recorded 42,000 foreclosure starts in January, the highest monthly total since early 2020. Completed foreclosures rose 35% year over year in February. The states leading in distress: Florida, Texas, Indiana, and South Carolina. To be clear, these numbers are still well below 2008 levels, when 23% of mortgages were underwater versus 2.1% today. But phase two started as a drip too. What matters is the direction, and the direction is accelerating. Quick note, we just moved through about 47 data points in 3 minutes. That's exactly why this channel exists, so you don't have to spend your weekend buried in Intercontinental Exchange mortgage monitor reports. Though, honestly, if that is your weekend, we should probably compare notes. Hit the bell so this lands in your feed the moment it's live. The people tracking this data closely are going to come out of this cycle in a completely different position than those who aren't. Now, the second major story, commercial real estate. This is no longer a looming threat. It is actively unfolding. Office CMBS delinquency hit an all-time record of 12.34% in January 2026, surpassing the post-financial crisis peak by 1.6 full percentage points. Multifamily CMBS delinquency surged 239 basis points year over year to 6.85%, the largest single sector increase across the board. Multifamily was supposed to be the safe corner of commercial real estate. It isn't anymore. Between $875 billion and $936 billion in commercial real estate loans mature in 2026, an 18.8% jump over 2025 volume. Last year tells you what to expect from that. Of the roughly $957 billion that matured in 2025, only 50 to 55% was actually paid off. The rest was extended, modified, or defaulted. Distressed CRE assets reached $116 billion, up 31% year over year. Why does this matter for residential real estate? Because of the banking system sitting beneath it. 1,788 banks, more than a third of all U.S. banks, carry CRE exposure exceeding 300% of their total equity capital. Of those, 504 exceed 500%. S&P Global projects that bank loan loss provisions could climb to 24% of net revenue in 2026. 2 banks already failed in 2025 due to CRE stress. And in February 2025, the FDIC stopped disclosing total assets on its problem bank list. They reduced transparency at precisely the moment it mattered most. Now, the builders, because they're sending the clearest price signals in the entire market right now. New home sales collapsed 17.6% in January to 587,000, the slowest pace since November 2022. Inventory sits at 9.7 months of supply, firmly in buyer's market territory. Builder confidence has stayed below 50 for 23 straight months, and the concession war is escalating. 37% of builders are cutting prices outright. 64% are offering sales incentives. Lenders' incentives now average 13.3% of the sale price, roughly $60,000 on a $450,000 home versus a historical norm of 5 to 6%. Polk Group's per sale incentives more than doubled, surpassing $52,000. D.R. Horton is sitting on 7,300 completed but unsold homes and is offering 3.99% FHA rate buydowns to move them. Existing home sellers need to hear this clearly. You are no longer just competing with other sellers. You are competing with large-scale builders willing to hand buyers $50,000 to $60,000 in concessions. If you're listing a resale property in a Sunbelt market and you're not pricing to reality, the builders are taking your buyers. So let's pull it all together. What exactly is Phase 3? Phase 1 was the freeze, 2023 through most of 2025. Buyers and sellers both stepped back. Prices stayed elevated because inventory was locked up. Phase 2 was forced selling till late 2025 into early 2026. The lock-in effect faded, negative equity spread, foreclosures accelerated, price cuts became standard in Sunbelt markets. Phase 3 is the fracture, and what makes it different is that it isn't uniform. The market has split along 3 separate fault lines. The first is geographic. Sunbelt markets are declining while Midwest and Northeast markets are appreciating. 2 Americas, 2 outcomes. The second is demographic. FHA borrowers are at 11.52% delinquency. Conventional borrowers sit at 2.89%. The bottom half of the market is deteriorating while the upper half largely holds. And federal policy is making it worse. FHFA just reduced the GSE affordable housing goals, cutting support for exactly the population experiencing the most concentrated distress. The third is property type. Single family is outperforming condos. Office commercial real estate is at record distress, while industrial thrives. New construction is being liquidated through builder concessions, while existing homes in supply-constrained markets hold their ground. What makes Phase 3 genuinely dangerous is that each of these fractures reinforces the others. Falling Sunbelt prices push more borrowers underwater, which accelerates foreclosures, which pushes prices down further, which reduces migration, which pulls away demand, which puts more downward pressure on prices. Job losses are adding fuel to every one of those cycles, and the geopolitical shock has removed the one policy tool, lower rates, that could have slowed the deterioration. But let's be precise about what this does and doesn't mean. Not every market in America is in trouble. If you're in Hartford, Rochester, Kansas City, or Boston, your market is supply constrained and actively appreciating. The fracture means some markets are in serious decline while others are performing just fine. The national average is hiding both realities simultaneously. So what does this mean for you specifically? If you're selling in a declining market, builders are your primary competition and they're giving away 50 grand in concessions. Every month you wait is statistically likely to mean a lower sale price. So Austin sellers who held on have already absorbed a 27.8% loss since 2022. Price to the market that exists, not the one you remember. If you're buying in a declining market, you have negotiating leverage that hasn't existed in years. 62% of buyers are closing below list price with an average discount of 7.9%, the widest gap since 2012. Builders are offering rate buy downs and $50,000 plus in concessions. Be patient, negotiate hard, and let the data lead. If you're in a supply constrained market, be cautious about overpaying. The migration patterns boosting the Midwest today are the same ones that were powering the Sun Belt 3 years ago. And if you own a Florida condo, especially in a building approaching its 30-year structural inspection deadline, you need to fully understand your exposure to special assessments and insurance costs right now, not next year, right now. We are in Phase 3, the market has fractured, and this is the part of the cycle where being informed versus guessing carries a real dollar difference. We're talking tens of thousands. At US Realty Pulse, we're going to track every development as this plays out. The new data, Fed decisions, foreclosure waves, migration shifts, all of it. If your notifications aren't on, the algorithm is going to bury this somewhere between a cat video and a weekend DIY project. Don't let it decide when you find out what comes next. Hit the bell and drop a comment. Tell us which market you're watching right now.